Alright, with all the noise about GameStop lately and Wall Street bets, I thought I would take this opportunity to explain what short selling is and how it works. Let's dive right into it. Hey everyone, Chris here from the Business Report Show. Before I begin, make sure to hit that subscribe button, and if you do enjoy the video, make sure to hit the like button as well. Every little bit helps. As a disclaimer, I'm not a financial planner or advisor, and everything I say on this video is just my opinion and for educational purposes only. Make sure to seek a professional before investing. For most investors, we are taking a stock long, meaning we are buying a stock with the expectation that it will go up in price. On the other hand, shorting a stock is the act of selling a borrowed stock with the expectation that the price will go down. Let's say you have investor A, who really believes Company XYZ is going to have a bad quarter in sales, and decides he wants to short the stock, expecting that once the bad financial news is announced, Company XYZ stock is going to drop. Let's assume Company XYZ is trading at $100 right now. Investor A goes to his broker and gets the broker to lend him one share of Company XYZ so he can short the stock. Investor A borrows one share and sells it to the market for $100, and $100 is credited to his account. When Company XYZ comes out with bad financial news, shares of Company XYZ fall to $50. Investor A then buys back one share at $50 and then returns the share to the broker to close his short position. Because Investor A initially sold the shares at $100 and bought them back at $50, Investor A gets to keep the difference of $50. Woohoo! It's an interesting concept of selling high and buying low, but it was a concept that started back in the 1600s. Over the last few decades, however, rules have been brought in to try and minimize market manipulation and abuses by short sellers. Here are some other technicalities to note for short selling. 1. You need a margin account because you are technically borrowing shares from the broker. Without a margin account, you can't short sell stocks. Number 2. There may be price limits, and your broker may allow you to short only stocks above a certain price. Number 3. As an underwriter or book runner of an IPO, you are not allowed to short initial public offerings until 30 days after they've started trading. However, an investor who wants to short sell would have to look for an institution or an individual investor willing to lend them the shares, so shorting IPOs can be quite difficult, although not impossible. And number 4, the brokers need to have the shares available to lend to an investor for shorting. So the big question on everyone's mind as of late is naked short selling. Many people may be thinking of the recent example of GameStop where 140% of the shares were shorted as an example of a naked short. However, in fact, that is not a naked short. Naked short selling is a method of short selling shares that have not been officially determined to even exist. It is when an investor shorts shares that they have not yet confirmed to have actually acquired from the broker. The broker and investor assumes they will be able to get those shares sometime down the road. So as you can see, this can be highly risky if things don't work out perfectly, which is why the regulators have made naked short selling illegal. Let's take a look at the example of GameStop, which is not naked short selling, but yet was able to get over 100% of the shares shorted. Let's say Jimmy owns shares of GameStop, and Jimmy and his broker have an agreement that allows the broker to lend Jimmy shares to short sellers.
Thank you.
It lends them to Jennifer, who subsequently sells those borrowed shares short in hopes that GameStop's share price will fall. An investor named Jeff ends up buying those borrowed shares from Jennifer. However, Jeff has no way of knowing that those shares have been borrowed from Jimmy. To Jeff, they're just like any other shares. More importantly, if Jeff decides he's going to have the same kind of agreement with his broker to allow his broker to lend those shares out to another investor, let's say Jackie. Jackie, another GameStop shorter, can borrow those shares and sell them short as well. In this example, the same shares end up getting borrowed and sold twice. The short interest volume these transactions add to the total is twice the number of shares actually involved. You can therefore see that if this happened throughout the market, total short interest would eventually exceed the number of shares outstanding, which is close to what happened with GameStop. Now don't get me wrong, I'm not saying what these hedge funds did to GameStop was right, but unfortunately from a regulatory perspective, what they did was not naked shorting and therefore technically not illegal. So just to end with 3 final points. The best possible outcome for shorting a stock is a 100% return because no stock can go negative in stock price. Whereas when you go long on a stock, the gains are technically unlimited as the stock can keep on going forever. While there are some market anomalies, typically long stocks take longer to make gains compared to the percentage drops in stock prices in a down market. So shorting shares sometimes accelerates those returns for those short investors. Now, number 2, on the flip side, the downside risk of shorting is that your losses could technically be unlimited. Using our earlier example, imagine if Company XYZ stock moves up instead of down and continues to move up to $500. Investor A would be on the hook for buying back stock at $500, and after taking into account the initial $100 credit they received, Investor A would actually lose $400. As you can see, there's no telling how large those losses can be. What's worse is when the short seller is required to close out those positions. Especially if the short seller is borrowing a large amount of shares, they need to cover large shares that would be at the mercy of the long investors. During these covers, you typically see another surge in share price. One term you'll often hear relating to this is the short squeeze, or lack of shares and an excess in demand. My third and final point is there a place for short selling? It's a strategy that some investors use as a hedge against drop in share price so that you have an opportunity to make money when stocks go up and also make money when stocks retreat without having to wait for the next dip to buy the stock. I think like most things in life, anything in moderation is healthy, but when large funds start skirting the regulatory rules and begin manipulating the market by abusing short selling, then perhaps short selling wouldn't have a place in the investment marketplace. There are definitely many arguments for and against short selling, but there's no doubt there needs to be a review of how there can be better level playing field for all investors. That's it for this video. Leave me a comment below and let me know your thoughts about short selling. Do you think it's okay or not okay? Also, don't forget to hit the subscribe button and the like button. Every little bit helps. Remember, always be learning, always be investing. I'll catch you in the next video.